This year, I think total return, and maybe for a while, total return is not looking fabulous. It is for coupon. I think we're getting to a stage where if you're just looking at high quality bonds, spreads have really come in so much in all the spread sectors. And if I look at treasuries, I actually see them as being pretty fair where they are.
Yeah.
Between I've been calling for 425 to 475 most of this year, and I have no reason to really alter
Right.
that very much.
Kathy Jones with us earlier was Schwab, and she just puts out on Twitter an amazing chart. And this is something I don't look at, Paul, but it's basically 10 or 15 bond categories, bank loans, all the stuff Franklin Templeton does. Paul, I would have done better in cash.
Cash, I know.
That's the challenge.
Exactly. All right, so in honor of Joe Mysak, who is enjoying his first day of retirement today, the Dean of Municipal Reporters out there, talk to me about the municipal bond market. I think I can get some really attractive tax equivalent yields out there. How do you view the municipal bond market?
We do like it. We like the municipal market. We think technicals are favorable. You know, it was very out of favor for most of last year, enormously so. And this year it is coming back, and it is one of the areas which we like. We think actually, you know, to go back to what you and Tom were just saying, you could have done better in cash. This is true, yeah, but you can't stay in cash. That's the risk, because you've got to start dipping your feet back into the bond market. My advice would be at least go ultra short before you take the deep dive, because when the time comes, you won't always have the yields which you currently have. Now, total return is something we've gotten very used to over the last 20 years of easy money and liquidity, but I don't think that's not where the bond market necessarily is going to take us over the next several years. It's going to do what it says on the can. It's going to deliver a certain amount of income, ideally with less volatility than we're seeing right now, as markets adjust to what I think is the new state. The new state, which is a lot like the old state, which was from the 1950s until the global financial crisis. But, you know, bonds delivered decent returns, but not equity-like returns.